Betting on horses isn't the only Melbourne Cup Day tradition. It's also traditional for Australia's central bank to move interest rates. November has usually been the month the RBA has seen fit to curb free-spending consumers with an interest rate hike. The gamble now is whether they'll cut. Here's Philip Lasker.
What's the definition of a lucky central banker? Not a Melbourne Cup winner, but a policy setter with choices. The RBA Governor and his deputy, Rick Battolino, certainly have them, partly because inflation is less of a problem than was thought just a few months ago.
It provides scope for monetary policy to be supportive of economic activity if needed.
It is needed if the latest business survey from the Chamber of Commerce and Industry is a guide.
It does show that expected economic performance has indeed deteriorated and is at contractionary levels, as are many other indicators in the survey, including businesses' view about general business conditions.
But not all economists see the evidence.
I'm not convinced there's a strong case for interest rates to go down at all, in fact, and I think the economic numbers over the last month or so have been pretty firm. And even on the forecast that the Reserve Bank published back in August, inflation was above target. So that's probably been downgraded now, but I still don't think there's a case to cut interest rates.
Some of today's data would have added weight to that view. Private sector credit, while still pretty flat for the year, has risen 2 months in a row. And capital city house prices continued falling for a 9th month, but the rate of decline seems to be easing. But Westpac's Bill Evans, who's been forecasting rate cuts for months, isn't surprised by the recent pickup.
Consumers are now anticipating that the Reserve Bank will cut rates, and that's provided them with a little boost. We certainly saw in September that the Consumer Sentiment Index was up by 7%, and I think that was mainly due to the fact that consumers accepted the fact that the Reserve Bank was no longer likely to raise rates, indicating just how sensitive they are to interest rate expectations.
And then there's the sensitivity to ongoing uncertainties surrounding European debt, weaker commodity prices, including iron ore, and an Asian region which has experienced weaker currencies and falling share prices.
I think what that's telling us is that Asia is not entirely resilient to what's happening in the rest of the world. So I would imagine that even though the European story appears to have some short-term stability, the turnaround in Asia is the thing that will most attract the interest of the Reserve Bank, hence adding to the case for some relief in this economy.
But some say even if the Reserve Bank cuts rates, it won't ease the pain where it's needed in sectors struggling because of a strong Australian dollar.
The interesting point is the currency remains very, very high, and it looks like it might go a little bit higher if the US Central Bank does proceed with this next round of quantitative easing.
Thankfully, Australia's central bank is still making conventional decisions using conventional economic weapons.